Battery storage is getting a lot of attention these days because of the integration of renewable energy into power grids. So I'm going to talk to Julian Jansen from IHS Markit about a study he and some co-authors wrote entitled Capitalizing on the Growth of Battery Energy Storage in North America. So welcome to the interview, Julian.
Great to be here.
Well, let's start with your numbers. You're talking about $24 billion in Canada and the US over the next, well, say 4 years. Can you break that down for a little bit for us, and how significant is it?
Yeah, absolutely. I think, first of all, it is a significant investment, especially when we're looking at where the industry is coming from. I mean, really 2021 is seeing huge growth. We're expecting close to a tripling in total investment going into energy storage this year compared to the previous year. And I think that really shows how the market is gathering momentum. But fundamentally, what we look at there is really component hardware costs as well as project development and EPC. So of course, that 24 billion isn't everything that's flowing into that industry, right? There's wider costs in terms of hybridization with different types of power plants. There's interconnection costs. There's a wider supply chain value chain that sits behind it, whether that's software, whether that's the long-term O&M, lifecycle services, and so on. So I wouldn't get too narrow on the single number, but at the same time, it really highlights a huge investment growth of the industry.
Now, it wasn't that long ago, I interviewed an economist from Berkeley who was saying that with all the hype around battery storage on the power grid, it still is a drop in the bucket compared to the renewables that California, for example, is installing. Is battery storage trending towards having a significant impact on the grid and on the integration of renewables?
Absolutely. And you have to remember that energy storage, or battery energy storage in particular, it's an enabling technology, right? So we're never going to see quite the same scale as we would see in terms of power generation. But what battery storage and wider energy storage technologies do is they enable the effective integration of renewables into our power grids. And as such, plays a crucial role if we want to meet our decarbonization goals. We need energy storage and different energy storage technologies over time to enable that. But of course, it will only grow in line with that renewable growth and not be the end of all.
No, okay. So we've got a significant amount of capital going into the battery storage system market in North America. What are the drivers to investment?
Yeah, absolutely. I think this is a crucial question because the industry is still in a stage of nascency. And I think that's something we have to remember. Everyone's talking about storage and everyone has been talking about it for a few years, but we're still at a very early stage. And only over the last couple of years have regulatory reforms like FERC Order 841 that have only been enacted over the last few years enabled better access for energy storage assets into wholesale markets, both on the front of the meter, but also increasingly on the behind the meter side, recent FERC orders. So that's certainly played a crucial role and has enabled storage to play within energy markets and actually realize the value it can provide. At the same time, we're seeing states implementing energy storage targets, mandates, and incentives, but almost more importantly, providing guidance and utility procurement processes, because in a lot of cases, it's already competitive with other options as long as you provide education guidance on how to procure it. We've also seen the federal ITC, which has significantly improved the economics for solar plus storage systems. So at the moment, it's obviously only for those hybrid systems, but we're seeing a lot of bipartisan initiative for both a standalone energy storage tax credit and an extension of that. And then we've seen huge cost declines, right? I mean, we've seen cost declines in excess of 75% since 2012 for lithium-ion batteries, driven by the automotive industry. And that's enabling storage to be competitive with other options on the energy market.
I see on your chart that you've got a small but still significant investment in behind the meter for commercial and industrial. So basically, we're talking about customers that want to self-generate, mostly using solar. And I understand that a lot of that is driving, change in the utility industry because they're worried, utilities are worried about losing some of their big customers. How significant is that trend?
Yeah, so there's two elements to this. We are seeing an uptake in behind the meter commercial industrial energy storage systems, But at the same time, it's certainly not growing at the same scale as we're seeing on the front of the meter side. And there's multiple factors for it, but fundamentally, it all comes down to the economics here. And that's really driven by rate structures and the ability to offset specific types of demand charges with energy storage systems. So it's highly dependent on regional differences. And at the same time, it requires a much bigger business development effort for the developer or for the integrator, because of course you're selling smaller systems. So I think because of that, we're seeing that slightly slower growth. We've had the economic impact of COVID-19 as well. But if we look at this long term, I think certainly when we're looking at sustainability and ESG initiatives for corporates, but also looking at resiliency and trying to mitigate against grid outages like we saw in California, like we saw in Texas, that will play an increasing role. I don't think utilities have to fear losing customers, but I do think they really need to start moving into a direction where they can understand how they can best integrate those behind the meter storage and distributed generation assets to make use for it, both for the customer and for the system.
Now, who's investing in battery storage and why is that significant?
Yeah, I think we're seeing a really interesting combination of investment. And I think we're seeing a real shift in the types of investors that are now looking at this. I think historically, we saw some smaller funds, venture capital pushing into this market. And I think now we're seeing really mainstream capital across the energy storage industry, whether that's private equity, whether that's traditional energy infrastructure funds. We're seeing certainly more and more interest in storage assets from them. We're seeing more and more debt financing as well. And of course, corporate investment, right? I mean, most large energy companies are certainly looking at acquiring energy storage companies and acquiring energy storage developers or building up that capability themselves. And I think fundamentally it's driven by two factors. It's first of all, the fact that we are now seeing that ramp up in deployment, and also investors becoming more comfortable with the more merchant revenue risk associated with storage. But also we're seeing this clear shift, which has been accelerated by the COVID crisis, creating momentum for investment into low carbon energy. And we're seeing a lot of traditional energy players moving into the clean energy space.
That's an important point for many of our readers at Energy Media because we do hydrocarbon reporting, and we've heard about the shift away from oil and gas, for instance. And is that where a lot of this capital is going? That they're getting a better return on the new energy side, and so they're shifting away from the traditional oil, gas, and pipelines?
I'd be careful saying that they certainly will be getting a better return. I think it's much more nuanced than that, and it really depends on the type of technologies we're looking at, type of markets we're looking at. But I think fundamentally there's a lot of pressure now from activist investors, from policymakers on ESG metrics, but also recognition of that kind of environmental and social responsibility that investors hold in enabling that change. I would also say there's a different approach probably for oil and gas. I think gas is still a crucial transition technology with plenty of opportunities across the world. So I think it's a mix of that those ESG initiatives, corporate pressure and political pressure, and fundamentally also a recognition of that's where long-term growth will be, even if returns are not always comparable or necessarily more attractive in the short term.
So you make the point in the study that business cases for battery storage are improving. Could you explain that, please?
Yeah, absolutely. And I think a lot of that comes back down to the point I made earlier around market access for storage projects, especially being able to access wholesale markets. And historically, what we saw was that there was limited opportunities for storage to be competitive, you know, whether that was frequency regulation in PJM or, for example, capacity contracts in California. And often investors were always looking at this one kind of anchor contracted revenue streams. They weren't necessarily comfortable with the merchant risk that some of the wholesale revenue streams pose. But as storage costs have come down and investors and also the operators and developers become more comfortable with those merchant revenue streams, we're now seeing huge ability of storage assets to capture price spreads in intraday wholesale markets. Again, Texas is a crucial example there. And pairing that with other revenue streams, whether that's capacity contracts, but also seeing more and more PPA procurement for solar plus storage plants, because they are the lowest or one of the lowest cost options to provide firm capacity for the future. And as such, they're simply competitive with new build gas turbines.
Quick question about the corporate power purchase agreements. How important is that trend going to be towards further battery deployment on the utility side?
Yeah, I think we're at the start of a development here. I think companies like Google have come out that they want to procure basically 24-hour renewable energy, right? Not just basically meet 100% of their electricity demand procured from renewables, but actually having fully renewable electricity supply. And to achieve that, you need energy storage. I mean, yeah, you can have a great portfolio of hydro, solar, wind, and you probably will get close to that. But in the long term, and if we want to look at all the different assets within that, you will need storage to enable that, whether that's on site or whether that's somewhere in the grid and you have a more kind of virtual PPA type of contract structure. Now, companies like Google are leading that development, and it will take time for that to trickle down. But I think over time, a lot of corporates will be looking at 24-hour low carbon electricity supply. So therefore, we will need storage to enable that on the grid, to enable those type of PPAs at competitive prices for a large range of customers. And again, that ESG pressure from investors is going to play a role in moving the needle towards that.
Now, you make the point again in the study that SPACs, the special purpose acquisition companies, are becoming a vehicle for startups to go public. How important is that to facilitating investment in this sector?
Yeah, we've seen quite a lot. I think in 2020, and this is not just storage related, but I think in 2020, we saw around 16 clean tech and e-mobility SPACs in North America. I think an average valuation of $2 billion. And we expect more of that to happen. I think it's now a really easy route for companies to move down to raise investment much more quickly than traditional routes. Also, maybe not necessarily the same scrutiny and the same cost to them as a traditional IPO would be. And certainly there's some significant cash benefits, media attention, and it's a great way to finance scaling. But at the same time, companies that have been through the process will need to demonstrate in the long term that they can generate the revenues and the returns for investors. And I would say it is, and often it's a qualified bet. Some of these companies will certainly fail. Some of these companies won't fail, but they'll fail to materialize the growth that they're advertising. And then there's going to be one or two really successful companies that will be able to provide huge returns for their stakeholders. But there's also clearly a bit of a hype. And I know from experience, there's plenty of smaller companies that are trying to grow, that see this as a viable route over the next 1 to 2 years as a core target to raise capital and pay back their early investors.
Julian, thank you very much for these insights. Really appreciate it.
No, thank you very much for having me. It's great speaking with you.